I wanted to create a video on remortgaging, as there's a lot of videos on YouTube that help first time buyers and even home movers, but I feel there aren't enough to help you, someone who needs to remortgage. So if you're coming to the end of the product term on your first mortgage or even your 10th, or you're curious about the process in the future, then this video is for you. Hi, if we haven't met before, I'm Dan and I'm a CMAP qualified mortgage and protection advisor. This video is purely for educational purposes only and should not be seen as advice or a recommendation to act, and I must stress your home may be repossessed if you do not keep up with the repayments on the mortgage. With that out of the way, on with the video. So why would you remortgage? When you take out a new mortgage, you could have been placed on an introductory deal. For example, on a low fixed or discounted rate or a low tracker rate for the first few years of your mortgage. Introductory deals normally last for between 2 and 5 years. Once the deal ends, you'll probably be moved onto the lender's standard variable rate, which will usually be higher than other rates that you might be able to get elsewhere. So when your introductory period ends, take a look at the market to see if switching to a new mortgage deal will save you money. Bear in mind that if you only have a small outstanding mortgage, then the amount that you can save might be too low to make switching worthwhile. Remortgaging can offer you more flexibility. For example, if you want to overpay on your mortgage, there are products out there that will allow you to do this. Or maybe you want to switch to an offset or current account mortgage, where you use your savings to reduce the amount of interest you pay permanently or temporarily, and then you have the option to draw your savings back if you need them. You may also wish to remortgage for debt consolidation. If you have a lot of debt, you might be tempted to borrow extra money on your mortgage and use it to pay off other debts. Even though interest rates on mortgages are normally lower than rates on personal loans and lower on credit cards, you might end up paying far more overall if the loan is over a longer term. So please think very carefully before securing other debts against your home. Instead of adding debt to your mortgage, try to prioritise and clear your loans separately. How to check the market for mortgage deals? There are two main ways that you can do this. You can do this yourself by using comparison websites, or you can use a mortgage advisor such as myself. I covered a video on why you'd use a mortgage advisor here. Something to keep in mind is on occasions comparison websites won't all give you the same results, so make sure you use more than one site before making a decision. It is also important to do some research into the type of products and features you need before changing lender. Before you switch, make sure you check out the costs of the mortgage. Some lenders might offer fee-free deals to tempt you, but if they don't, you'll have legal and valuation and administration costs to pay. You can use the annual percentage rate of charge to help you compare deals. The annual percentage rate of charge is a way of calculating interest rates that incorporates some mortgage related fees in the calculation, giving you a way to compare mortgage deals. What might look like a money saving deal could end up losing money if you don't do your sums first. Reducing your loan to value to get a better rate. This is easier said than done, and I appreciate that, but it might be an option. Every mortgage deal has a limit on how much you can borrow when compared with the current value of your property. This is shown as a percentage and it is called the loan to value, which I'll come on to in a minute. When you remortgage, the lower loan to value you need, the more deals that might be available to you, and you might be able to get cheaper mortgage deals too. If you have surplus funds, sometimes it can be beneficial to reduce your mortgage borrowing by paying off a portion of the mortgage to obtain a lower loan to value, which in turn potentially means a better interest rate. Make sure you take this into consideration if you're not using a mortgage advisor, who would usually consider this for you. How to calculate your loan to value. Divide your outstanding mortgage amount by your property's current value and multiply the result by 100. For example, if your outstanding mortgage is $150,000 and your lender thinks your property is worth $200,000, $150,000 divided by $200,000 is 0.75. So 0.75 times 100 is 75. So your loan to value is 75%. In this example, you could qualify for 75% loan to value rates. But if your mortgage balance is $152,000, you'd be sitting at 76% loan to value, and you can't qualify for 75% loan to value. So you'll be pushed up to the 80% loan to value rate banding, which could cost you more over the term of the mortgage. The valuation. When you apply for a mortgage, the lender's valuation might just involve checking the outside of the property from the street. This is called a drive-by valuation. You even get AVM valuations, which stands for Automated Valuation Model. This is where a computer calculates the property value using historic data and trends. If you think the valuation is too low and that you're losing out on a better rate as a result, ask the lender to instruct a physical inspection. You could be charged for this valuation to take place, so find out the cost of this valuation and work out if you'll make the savings by being placed on a better loan to value rate. To support your case, you could provide evidence of the sale price of a few similar properties in your area, and if relevant, list the cost of any expensive home improvements you've carried out. So I've covered some of the reasons you would remortgage and some of the things you should consider. To avoid making 10 of the most common mistakes when buying a home, watch this video. If you found this video helpful and you wish to buy me a coffee, I've put a link in the description below. But even more importantly, if you want my help, please contact me. Remember, your home may be repossessed if you do not keep up with the repayments on your mortgage. Thank you very much for watching, and I'll see you next week.